how to invest better than private banks, how to get better results than the highest paid professional fund managers, especially in Belgium. That's the question that we're discussing and answering today. And to help me with that, I have invited Tim Nijsmans. Tim was a private banker and a fully convinced active fund manager for more than 10 years. One day, he decided to compare the performance of private bank funds with index funds. And after seeing the differences in performance year after year, he could never turn back. In this episode, we discuss how private banks work and how they benchmark their own performance. And you see that they have a few interesting tricks. How Tim discovered the power of index investing and what made him switch. By how much private bank funds actually underperform index funds. And we're going to dive into the numbers and quite a lot of details. How to invest better than private banks. And at the end, we talk about the psychology of investors in retirement. More specifically, we compared the performance of defensive, balanced, and dynamic bank funds to their equivalent of index funds and portfolio of ETFs. We look at the numbers and we highlight the differences, which can be quite big, as you will see. If you invest with the bank, if you have a bank fund, or if you're curious about the differences between private banks and index funds, then this episode is for you. Tim is the founder of vermogengids.be, one of the only, if not the only, flat fee independent financial advisor in Belgium. He teaches private banking at Artevelde University in Ghent. He's the co-author of The Hangmat Beleger with a bunch of text in Dutch. It's basically a book about investing from your hammock. Amazing book. If you speak Dutch, you have to get it. Tim is active on the board of the Vlaamse Federatie van Beleggers, and he manages the Facebook group Belegen. Tim is also an independent consultant for FIRE Belgium. So if you find this conversation interesting, or if you want to speak to Tim, then I invite you to book a call with him following the link that we'll provide in the description. And I also want to remind you that if you're interested in learning more about how to start with index investing, there is a free workshop on the FIRE Belgium website where I teach you exactly how to get started. You go to firebelgium.com/investing workshop. And in that workshop, which has been already seen and used by thousands of people, I explain exactly step by step how to get started and how I can help you with the practical aspects of it. All right, let's go. Welcome everyone to another episode of the FIRE Belgium show. Today we have a special guest, someone that I've been speaking to and I've been really fascinated by for many years since I came back to Belgium, and that is none other than Tim Nijsmans. Welcome, Tim.
Thank you, Sebastian. Thank you for the invitation.
I've been looking forward to this conversation, to recording it, because we've had many conversations that were really, really interesting. And every time I was like, oh, I wish we had recorded this for the podcast. So today is that time. So I might ask you a few questions we've talked about before, but we're not doing this for me. We're doing this for the FIRE Belgium audience. But certainly before we start, it'd be great to have a bit of a background about you. I've already provided an introduction as to like all your successes and what you do and all of this before the interview. Obviously, it's in the intro. But if you could just tell us a little bit, what's your background and what led you to where you are today?
Okay, so from a young age, I've been fascinated about the financial markets. So I was a teenager and I started to read books, the active style of investing, about individual stocks, and the book Winnen met Aandelen, where there's now a new edition from Roland van der Elst, was the first book I rented from the library. So I went to study it, economics at university. Then I became involved in the student investment club. I became president. I had an internship as a market maker in Belgian stock options on the stock market floor. And I rolled into, of course, the financial industry, like you would expect. First at a big bank in Belgium, Fortis. But then later on, I got my big break. The place where I learned the most was at a rather small private bank, Dirk Sleijs in Antwerp. So there I went through the ranks from trader, advisor, even bond desk. There I learned on bonds. Then I moved up to analyst and portfolio manager. and I ended my career as a portfolio manager and a fund manager. So I managed a fund for the bank. But then I grew tired of the active management, and I started my own passive advisory, de Vermogensgids. I also work with the Vlaamse Federatie van Beleggers, the VFB, and I teach private banking at Artevelde Hogeschool. And maybe you know, I also wrote a book together with Joran Bronsema called The Hangmatbelegger. So that's, in a nutshell, my background.
Yeah, so you're doing a lot of different things. I don't know how you found the time to write a book on top of that. So well done. Congratulations on the book. It's been a success from what I've heard, and a very, very good book and with lots of very practical tips. So certainly a recommendation to everyone in the community. It's quite interesting that you have this background of active management and active investing, but somehow you saw the light, you had an epiphany moment that made you understand that there was a different way, and that wasn't necessarily the traditional way or the way the industry does it at the moment. I'm curious about a couple of things. First of all, this is certainly something that brought you to my attention strongly, because I am looking for people who are teaching what you teach and doing what you do, because I think that's what people in Belgium need. That's also why you're on this podcast, of course. But I'm really curious about like a bit about your experience in the private bank around active management and the performance and its usefulness to the clients, and how all of that works like within, like before we go into all of the index investing, passive investing part. But talk to me about active, like what it's like to actually run a portfolio there and to be probably accountable for results and performance, and how is that compared to others, and like what's it like to be in that place?
Okay. So I think in 2006, I was promoted to a portfolio manager. So that was my first taste of how to manage other people's money. I managed about 300 million euros for about 200 clients. And this was before the financial crisis of 2008, 2009. So before the big regulations came. And I'll give you a taste of how it's like. What we asked for remuneration, the costs, it was 10% of the net profit of the portfolio with a watermark, or 0.3% on the assets under management. So in that time, I could manage people's money for a reasonable fee. But this was before all the extra MiFID and other kind of regulations and new laws. What did I do? I individually with the client talked what they would like, what kind of goals they had, what kind of risk profile they had. Not the MiFID, not the test, but actually a conversation with the client. And I had the liberty at that time, and we'll get to the change. At that time, I had the liberty to make individual portfolios for each client a little bit different. There were the big lines, the big strategy of the bank, but within the big strategy, I had a lot of liberty to choose which suited each client.
Mm-hmm.
But let's be honest, the results of those portfolios, it's difficult to standardize them because each client had a different result. Each client had a little different portfolio. And when you're in the active management business, like I was, of course, you're thinking that you're doing the right thing. At the moment also, everybody in active management, I'm sure the most of them are working in a positive atmosphere, looking to create yields and returns for clients. So you're not in that business to work against your clients. That's not the goal.
Mm-hmm.
But you have a little bit of in your mental state. Of course, you have excuses for yourself and for the bank, because it's hard to look in the mirror and say, okay, I did a terrible job. Am I bad at my job? Nobody likes that evaluation. So what you do, there are a few tricks that we cheat ourselves with. We compare ourselves with other banks, so with other players. Then, of course, you compare active management to other active management, which is a lot easier than comparing active to the passive side,
Mm-hmm.
to indexes. Another little cheat is you can compare with indexes that are price indexes and not return indexes. For the listeners who don't know the difference, a price index doesn't take the dividends in account. A return index does. So it's usually 2 or even 3% difference between a price index, stock index, and return stock index. So, for example, the BEL 20 or the AEX in Holland, or the CAC 40 in Paris, are all price indexes. There are return indexes, but they are not the ones that you see in the news or in the papers or on the sites. You see the price indexes. So that's a few ways we cheat ourselves.
Yeah. So I was going to say the first way seems fair. You compare yourself to your competitors and you say, look, I'm better than my competition. I'm not saying that what I'm doing is the best. I'm certainly better than those that are doing the same thing, which I would say it's quite fair. But comparing yourself to a price index, knowing it's a price index and not a return index, yeah, that seems unfair.
Yeah, that's true. That's
and
true.
is it because it's easy because that's the indices that we see in the newspaper, and so because it's there we use that, or is it because we know we wouldn't beat the index if it was a return index?
Well, not to be too negative about the people in the industry, but what I just told you, that difference, I think a lot of people know it, but even more people don't know it. Even people in the industry. So I knew that, and some people at my bank also knew that. But if you talk to even management, or you talk to the let's say the advisors on the floor, I don't think they grasp the difference.
Yeah, because it's so much part of how it's done, right?
Yeah.
That's how we do it. It's the standard benchmark.
And if you day in day out you hear the BEL 20 has gone up, the Dow Jones has gone down.
Yeah.
Well, why not compare with the BEL 20 or the Dow Jones? So it's not all malicious. But it's little things that help. And of course, if we compare ourselves with our competitors, what was also a trick to it's usually a trick to convince ourselves, less clients, more ourselves. We put the banks that didn't do very well, and we put them in big letters, and the ones that do better, it's smaller font, and yeah, we adapted also the peer group. Sometimes if it wasn't going very well, we adapted our peer group.
Okay, we compared to some other
it was mostly convincing ourselves and management that we're doing well.
Yeah, internally
mostly.
Which makes sense. No, we all do that in our jobs to a certain point. Find the arguments to show that we've done a good job.
I can tell you one of my frustrations, one of my with clients, because of course you have also sometimes frustration with clients, was they have no idea about these things, no idea at all, not even the difference between the absolute return and a relative return. So if, for example, one year I had a very good year relatively, the stock markets were down about 10%. And for some portfolios, I kept the losses to -1%. So I did, in active relative management terms, I did a great job, 9% outperformance. And so I was happy. But clients walked in the door and said, Tim, this year you didn't do very well. You didn't work very well. I -1%. That's not good. So, okay, you can explain that, but it's still, if it's 10, 20 times in a row, you get a little bit annoyed at but at the same time, sometimes there was a great year in the indices, let's say plus 24%, and I did plus 16%. I was a little bit ashamed that I did 8% in underperformance. I had, like you notice, I had more of a defensive strategy. But people said, great work, Tim, great work, 16%, that's super. And I was like, you're not going to say at the client, oh no, I did very badly. You just don't say a lot about it. You're just happy with it. But so with clients, it's even a level, let's say, lower than benchmarking. It's even the difference between a relative return and absolute return that's very difficult for them to grasp.
Yeah, and when you, obviously from the client perspective, absolute return seems to be what matters. So the intricacies of how you calculate your own benchmark is not their problem. But I understand also, it's difficult because your best clients will be those that are most educated, but they might also be the ones that will challenge you on other things, certainly. And then you said that the costs evolved over time.
Yeah.
Right? Can you tell us a little bit how that? I mean, it's nothing. I don't want to be. I don't want us to talk about how the industry is bad.
Mm-hmm.
I'm
No.
interested in your experience and what marked you and what is now today playing a role in what you do, really.
Yeah. Okay. So after the financial crisis, there were two, let's say, different things that started to change. The first thing was the extra laws, extra regulations, and that made it difficult for people to have individual portfolios. The MiFID profile test came. So I couldn't do individual portfolios, more standard portfolios with my colleagues. And then you have to start working in committees, making decisions in group, making it accessible to groupthink. And so that was one thing that I thought was, oh, this is not the good way, because in group, I'm not saying individual investors have no problems. They do have problems. But if you're in group making decisions about investments, there are other influences that make decisions not better, usually even worse. So that was one thing that evolved. And the other thing was, okay, because of because for a part of all the regulations and standardization, okay, we have to pass those costs on to clients. It means if we want to work with fund portfolios and make them for everybody accessible, it's easier, but it's also easier in a fund to have higher costs. It's the invisible cost. You know that, of course, Sebastian. The management fee is deducted every day a little bit of the net asset value of the fund, and so you don't see it as a client. And in the first years where I worked as a portfolio manager, there was at the end of the year, or at the end of each half year, actually, there was a number the people had to pay. There was a fee, and the fee was deducted but they saw it on their, how do you call it, bank statements. Yeah, they saw it going off their portfolio. With funds and with the emergence of a lot of mixed investment funds. Profile funds are they called, I think, also. So they are defensive funds, neutral funds, dynamic funds. It's easier to have higher costs, so higher profits for the banks and private banks, and they're not they can make a profit. They're not in this business to help people from the goodness of their heart. They also have to pay their staff and their suppliers, so they do have to make a business, a living. But the costs became higher and higher and higher. And at the end, I was asking clients 1.4, 1.5% each year. I started at 0.3. So it was an evolution that I was having a difficult time to explain to clients. And those are the two things that changed internally in the financial industry.
So 1.5%, that is still very low compared to the average cost of actively managed funds in Belgium.
Yeah. So private banks, what I did, private banking has a little bit of a lower management fee because they only work for the somewhat larger portfolios, and then you have to be competitive with the other private banks, and there's a little bit of price pressure on those portfolios.
Okay.
So that's the reason why that's a bit lower.
Because today on average in Belgium is 1.7, 1.8. So unless it has kept going up, which might have also been the case, no, since that time until today, maybe it's percentage-wise have gone up. But so it seems like it's a bit lower than the average today. Really fascinating. Thank you for sharing this. It's really helpful. And so obviously you've made not a complete switch, but a very big switch to index and passive investing. Can you tell us a little bit how that went? What triggered maybe those changes?
So I was a completely convinced, very active investor. I even went to the annual meeting of Warren Buffett one time in America. So I was really, really convinced of that style of investing. But of course, with the changes after the financial crisis, I began to think, oh, is this the good way that we're evolving? And we launched a new equity fund with the bank. We launched our first equity. We had a mixed fund and a pension fund, and we launched our first equity fund. I was in the investment committee, and I had to sell it, of course, also to my clients. So I said, okay, I'll buy it. And ETFs were not new then, but they were not as prominent as they are today, but they were coming in the industry, they were known. So I thought, okay, let's buy an ETF at the same day as we launch our fund to see how good we will do. And I thought it will be interesting to see in my portfolio how well we are doing. And yeah, you can sense what happened, and it did happen. So the ETF surely, steadily but surely outperformed our own equity fund. And the first year you say, oh, okay, first 1 year, it's much too short to make an evaluation on that. And after 2 years, you say, oh, we had a bit of bad luck. It didn't go very well. And after 3 years, you say, okay, but the strategy was maybe for every active fund was a bit difficult in the last 3 years. And after 4 years, you say, yeah, but you have to look 5, 6 years. But yeah, after 6, 7 years of underperformance, you're running out of excuses. I ran out of excuses for myself. And that was, we launched in 2010. And so in 2016, 17, I was starting to get more and more interested in ETFs, in passive investment. I started reading up on it, John Bogle, a little book of common sense investing and articles about it. And I started to also check whether our competitors were maybe better. Maybe we were not a good active manager. Maybe we were bad. And I checked the other banks and other private banks, and to my consternation, they usually even did worse. They even had a bad result against the same ETF. And yeah, I was looking more and more to the passive side, and that's also the moment I started to a little bit, the standardization kept going, the cost kept going up. So at that moment, I also did an extra master at financial planning. So I thought, okay, maybe I can help people with planning, which is an extra bonus, an extra service that warrants our higher costs. So I did try to help my clients also on the planning side. But yeah, at a certain moment in 2019, there was even more pressure from management. And I understand management, the management of banks. That is the easy way, to have an easy way to manage people's money, to the risk profile, the MiFID compliance rules. So I understand from a management perspective that they wanted to go that way. But at a certain point, it went really too far for me. So something snapped, broke. I was coming home cranky. So they said at home to me, they said, why don't you do something else then? And okay, I was advising ETFs in the year before to people in my family, in my friends. I was already advising ETFs, and I was thinking about it, and I was saying, okay, I'm advising ETFs at everybody. Why am I still here? So, and that's and I thought, okay, let's make the switch to passive investment and to think about a business model where I'm happy, not where I make the most money, but where I'm happy, because that's a big difference in the financial industry.
Yeah, no, I can see that, and thanks for sharing the story, because it's a big change, and it takes courage, I think, to do what you did there. As you mentioned, is not necessarily the way to make more money, because we all understand that the financial industry pays well, especially at the level that you were at. And so certainly it took courage to change that. Would you say that today how would you compare financially your success today to when you left, more or less?
For the moment, I'm at the level that I left. So after 5 years, I'm at the same level that I made as a private banker. But it took 5 years.
Yeah.
It took 5 years to get there. And I work with the flat fee concept. Maybe I'll elaborate on that?
You
If I
can elaborate now. It's a good time to say, okay, so what's your current model? Because obviously you went from private banking to doing what then?
Yeah. So advising, but I didn't want it to. In the Belgian financial industry, there are a lot of rules and regulations, and if mostly they are aimed at joining a bank or being associated with a bank or selling investments. And actually, I was tired of selling investments to people. I was tired of doing that. But an independent advisory regulation or statute, like they say in Dutch, does not exist in that way in Belgium. So there was not something I could just jump into. So I had to think about it, and I thought, what if I change the model? Instead of making money on investments, on selling them or advising them or managing them in a percentage or on a transaction basis, why not ask a fee for independent advice that gives the advice around what I think are the cheapest, the best investments. A lot of them, of course, index funds or ETFs, but turn the model around and ask people who are in Belgium very used to getting free advice between parentheses. Free, not free, of course, because they are sold investment products that are very expensive, but ask them to pay for advice and then get in really independent advice. And that was a model that I wanted to start. They call it flat fee in America because you get you pay an amount and it doesn't rise if you have more investments, which it does in most financial investments in Belgium. You pay more if you invest more. So I'm a bit of a lone wolf. I'm not saying nobody else does it in Belgium, but they're not very well known then if they are, if they don't work with the same model. So that's how I work now with a year of flat fee gives you a year advice, a year-long advice, and with webinars, with individual meetings, with model portfolios. So that's the way I try to add value for my clients.
Yeah, so that's quite amazing. It's a big change. It's not something that Belgian investors are used to. How did you find it? Like, was it difficult to convince people that this was a better model, that they pay a flat fee? How, like, because obviously you also highlighted earlier that individual investors are not always very well educated. And so paying fee upfront for your advice compared to not paying for so-called free advice, but then paying high management fees, that must have been quite difficult. I wonder what's been your experience with this.
Yeah. So the ironic thing is that the people who contact me are actually usually very informed about finance, especially in the first years. Now it starts to change because of the book and because of a lot of other things, word of mouth and stuff like that. But in the beginning, I attracted people who knew they were paying a lot of money. They just wanted me to corroborate it and to advise a different strategy. But if I get people who don't know it, then I make an analysis of their portfolio, and their usually current investment portfolio is with a bank. And then I say, okay, your performance is less than passive, but also you pay, and I put it in euros to convince people, you pay X amount of euros each year to your bank. And the people who are not very interested in finance or very knowledgeable, they don't know that. They often are a bit, let's say they haven't thought about it. And if you say, okay, you pay 6,000, 7,000, 8,000 euros, sometimes they are completely unaware of this. And that makes a good way to change the conversation and say, okay, you pay me, of course, for advice, but you can usually the costs go, let's say, 10 times lower if you go to ETFs. So that's a good way to start the conversation. But to get people here and to listen to the story, in the beginning, it was very difficult. It was very difficult. It was people who were already a bit knowledgeable about the situation. But now, thanks to people like you, Sebastien, and other people who are preaching the passive investment gospel, let's say, it's starting to get more and more mainstream even in Belgium. It's one of the last Western countries. So that's the way I'm approaching it for the moment.
Yeah, it's just it's crazy that people don't realize how much they're paying. And I think there was change of regulations a few years ago that would mandate basically fees and commission to be more clearly displayed. Does it now say you're paying so many euros
Yes.
this
Yeah.
year? Does it say
So
that now?
each bank has to give one page with all the costs in concrete. But what happens? Usually they put that page somewhere in the back of a big book or one in the bank statements that nobody reads. Because I notice that still, even after a few years, when these regulations started, that a lot of people haven't seen the paper. Some banks are better at it than others. For example, KBC. I'm not making an advertisement for KBC, but they have it's very obvious. They really mail it to their clients. This is what you paid. But it's good intentions. I'm sure it's good intention, but that paper is a template. If you're not into finance, that template, you see a lot of numbers, but you see a lot of different kind of numbers. I don't know if you have seen one of those papers. It has like it's like taxes and others, and they split it up and then they count it back together, and it's for the amateur, let's say, it's difficult to interpret the numbers. So it's not one number. This is what you pay. It's like 12, 15 numbers, and it still is. I know it's a good intention, the paper, but
Yeah, it's better than
it's
no information, but it's still obviously it doesn't highlight the main thing that everybody should be aware of.
yeah,
But it provides information, so it's a step forward.
it's a step
right?
forward. It's a step forward.
Especially if they know the alternative and the price it would cost, then becomes that's kind of what they need to see, basically have an idea of how much they're paying and how much it would cost, and then compare the performance and the cost, and those two things together should be sufficient to think about making the switch. No,
Yeah.
so hopefully we're going in that direction. It's certainly, as we're saying, it's very courageous of you to start on this. When you started, did you know of anyone else in Belgium doing something like this?
No, no. So if I offend somebody, I'm very sorry, but I still don't know somebody who does exactly the same as
Yeah.
me with the flat fee. I know there are independent advisors. There are independent advisors, but they usually also work with a percentage assets under management. There are I don't know if they like to be called finfluencers that help people with courses. And of course, that's also a good way to approach it. But somebody who gives individual advice on a flat fee basis, I haven't met them yet, and I'll say that.
Yeah. And how much would you say is your work between you're doing financial planning in addition to investment advice or planning? Like how much of each do you do? Is it one more than the other?
It's more. It still boils more down to the investment side. That's my baby. That's where I'm most knowledgeable, if I may say so. And it's usually that's where it starts. But if I'm trying to make my model a bit recurring, so I try to keep people that want to have an advisor permanently year after year. Of course, I also help them with a little bit of planning to lower the inheritance tax, to help them pass things on to the next generation or their partner. So also I help there, but usually it starts really with the investment advice. Yeah.
Makes sense. Okay. And obviously you mentioned that you bought this ETF back in 2010 when your own equity fund was launching.
Yeah.
There's obviously this thing that we hear, and I'm not inside the industry, so I don't know, but that many people in the industry actually are investing in index funds while they're managing and selling actively managed funds. Has that been your experience? Do you know of that being the case or not necessarily?
Well, there's a little anecdote that maybe corroborates that story. I was selling my book at the book fair in Kortrijk, Booktopia, and there was somebody who was waiting a little bit till people were going away, and then he came with the book and he said, "Okay, it's against my own agenda, my own income, but I want to invest my money with the passive style. I work at a big bank in the private banking headquarters in Brussels." And he said to me, "And your book is popular," he said. I said, "Popular?" I thought I was
Yeah.
the devil in the devil for a lot of active private bankers. They said, "Yo, not for the clients, not for the clients, for their own money." He said, "Your book is becoming very popular within the industry." And I was thinking, okay, this is the best compliment I've gotten this year. And so I also hear that within the industry, a lot of people are investing passive. But of course, that doesn't pay their wages. It's the easier way is to work in active, get paid through the bank in active management, and it's good. Like you said, it's some people call it a golden cage. It's a nice job, well paid. It's intellectually stimulating. It's not too hard. And not too hard is maybe it has its tough points, of course. Every job has, but it's not bad. As an employee, you can do very you could do worse if you were an employee. And the bank, well, it's an easy way to work and provide for your family and pay off that big house you have and the kids who are going to college. And if you're not fire mentality, you up your living standards, and then you get in the golden cage. And if you want to jump like what I did, you have to your lifestyle has to be a little bit lower than it has been, or it always maybe has been a bit lower, but otherwise it's a painful switch, and it's a leap in the dark.
Yeah,
So it's understandable that most people are in the active industry. It's
of course.
understandable.
Yeah, I mean, to me, it makes complete sense from the fact that it's just been the traditional way, and that's the way we can actually pay people and pay for services, and it's well paid, so it attracts the right talent, and so they kind of.
And
But
I might add, the advice that the advisors and the private bankers give is usually good advice.
mhm,
The products that they use are too expensive and maybe not very good from a returns standpoint, but the advice that they give and the help that they give on planning and on risk profile, that's not bad.
absolutely,
They are
yeah.
doing a good job.
So isn't the product? I mean, they have a responsibility in the selection of the product. So would you say that they have the right advice, but they advise the wrong product? Isn't that then maybe that part of the advice isn't really good?
That part isn't very good, of course,
Mhm.
but the model would implode if they suddenly go to
Yes.
completely passive. The model would implode, of course.
And how much would you say? I understand that obviously because they do rely on commissions and asset management. So how much does that play a role in influencing the advisors? I mean, certain funds pay more than others. Certain products pay higher commissions than others. Like obviously, I always speak about this from outside. I'm like, to me, it makes sense that it would influence
Mhm.
the advisor's advice because some stuff pays him more than other, and the stuff that's very cheap that they first of all they cannot even sell it because like corporate wouldn't allow, but then they don't have an interest in doing that either because it doesn't participate in their own achievements and enriching their own corporation and shareholders and all that. But
Mhm.
then like it's so ingrained in the way it's working, like to me it's like it's almost for sure it makes no sense that there wouldn't be a conflict of interest or some bias there. But what's your experience with that? I don't know if you had that experience yourself or if you've heard from others inside.
I was always, of course, a little bit of an independent mind. That's maybe also why I didn't last long at the big
Mm,
bank.
you're not the
I
best example, no, but
I'm not the best example, but usually it's more, my experience is usually more the management regulations and going with the flow than actually thinking it makes. A lot of people are not in the industry based on commission, for example. Most of them are just paid a wage, a fixed
Mhm.
wage with a bonus at the end of the year. Now, of course, the bonus can be bigger if you do well according to the management objectives, but it's not, in the most cases it's not really from, okay, if I sell this to the client I make more money. That's
Okay,
usually not the case. Sometimes, of course, it is.
depends on the structure, yeah.
It depends on the structure of the remuneration of the advisor. And I do, of course, if you go, for example, there are also independent advisor who sell investment products. Of course, for them it is even more obvious that if they sell a product that they get a big retrocession on, a big part of the management fee goes back to them, then that's one-on-one. If they sell it to the client, they make more money. And I'm uh, I know everybody needs to make money. I'm not saying it's bad advice per se, but there is a link, of course. For me, for example, if I talk to one of my clients and they don't do what I suggest, it's just my ego. It's not my wallet. It's
Of
just my
course, no.
ego
Mhm.
that's hurt. But if your income depends on it, you're selling a bit harder, because it's if they don't come to you with their portfolio, or if they don't do the transaction with you, you don't earn anything. The talk has been wasted. You didn't make any money for the free advice talk, between parentheses. And that's not a good model. I think that's not a good model for the future. I hope more people go to or flat fee, or they're less, let's say, evaluated on how much they sell.
Mhm.
How much they sell, how much clients they have in certain systems. I hope it goes in that way, but I'm realistic, of course. The bank likes, of course, selling more. And the stock, the shareholder also wants more money.
Of course, yeah. No, so it makes sense from an internal structure perspective. So, and it doesn't mean that's the best for the clients. It's just it makes sense internally, and the people who are working there, and that's what they've been doing, and that's how they pay for everything in their life. It's kind of like you can't blame them.
Yeah.
But certainly, there's it's always looking for solutions, and I'm always looking for solutions because I'd like this to change. It makes no sense to me, but then I don't necessarily want to hurt the industry. I just
Mhm.
want the industry to find a better way of doing this, even if that means it has to, reduce its size because it doesn't get the same kind of budget to function, whatever. But there's a way that, basically both me and you, we know that especially the investing side is fairly simple and it doesn't require like a lot of time or a lot of analysis to design a portfolio that's going to be suitable to somebody's personal situation. And a lot of the investment advice and the cost associated with it is inflated compared to what it would actually cost to do it properly, like you're doing now.
Yeah.
So certainly there's this whole question there of like how much fees is being taken from investors and how much would actually be needed if we could just focus on evidence-based investment advice,
Mhm.
which would simply make it so much simpler and much more lower costs, basically. No, anyway, but you're playing a big role, I think, in Belgium in showing that there isn't another way for financial advisors, financial planners to make this work. And so
Mhm.
you're working hard, you're busy with so many different activities, and you're always giving in terms of knowledge and support. And I think, it's great. What I wish is that this interview might, inspire a few people to consider this path and to go and, basically it works because you've proven it. Others are probably doing it too. But
I hope.
certainly, I think if we have more of you guys,
Yeah.
Belgium would
I
be
I
better.
I hope it's a little bit of my a little hope is that there are other people who will start also with a flat fee business,
Yeah,
and we will multiply our numbers, and it becomes indeed a trend, and that trend will push also the industry
of
to
course.
reflect on their costs and on their way of looking at it. And like you said, if they shrink for example, if they shrink the investment committees or the size of the analysis, they can pass on the savings to the end clients. And maybe in America, I think active fees are even 0.7, 0.8 or something
Yeah,
like
they're
that.
very low. Yeah,
Yeah,
there's obviously economies of scale given
yeah,
the size of the country,
yeah,
but certainly it can go down because we don't have the competition of flat fee and low cost investing in Belgium yet.
yeah. That's true.
Investment funds are mostly controlled by banks, so the flow of money is really controlled by banks, and banks don't offer the low cost alternatives.
Yeah,
So just with that, we're in a position where the money is locked in that direction. So
yeah,
we have to create the other approach, the competitive approach, so that then it becomes an alternative that either they have to provide or they lose business.
yeah.
That's that's kind of the way we change things from the bottom. And maybe we'll try to change things from the top as well, but that's a different conversation. Awesome, Tim. It's super valuable. It's very insightful, and appreciate that you're sharing all this. Let's as discussed, let's take an example of
Yeah.
the work you do for your clients. And so let's
Mhm.
take an example of portfolio of funds that you see people coming to you with, and then let's talk about what is then the alternative and how you would go about, presenting a solution. And so for the people who are listening to the audio version of the pod, Tim is now going to share a couple of slides. So if you're interested, you can always go to YouTube and check it out. But we will describe, what's important so that you don't miss anything, even on the audio podcast. That's really important to me. With that being said, let's go.
Yeah. So I'm trying to give a portfolio analysis of active funds versus passive ETFs in this case, and to look at it from the Belgian perspective, what is on the Belgian market and what is the result? What are the results of the last 5 years? And how the building blocks of most portfolios, I don't have to tell you, Sebastien, are bonds and equity. Bonds and stocks are the building blocks of most investments in Belgium, usually in a mixed fund, but we'll go to the mixed funds a little later. Let's start, for example, with an overview of the bond funds, in Belgium. 5 years ago, I made this list, so I didn't know whether they were going to be good funds or bad funds. I just selected them, and those were available at that time. And if they were bad funds, the bank could have shut them down, or or merged them. So it's what you call a stake proof. It's a sample of the Belgian active management situation. And
So
some
you selected those funds based on those that were available,
yeah, for retail clients.
For retail clients of private banks and just regular banks.
Yeah. Okay. So just a few bond funds from the good, the premium, the biggest banks or biggest private banks. And also, of course, some ETFs, some bond ETFs. In the bond side, there is let's say it, there has been more interest of late. The last year has seen a lot more interest. Before that, there was little interest in those kinds of course, the yields were zero, around 0%. So that makes that there's less history to see at the bond level. But there are ETFs that are bond funds. So I made a combination of government bond ETF and the corporate bond ETF. So debt issued by the government or debt issued by companies. And if you see a 5-year performance, we're going to make a comparison on 5 year because that's the history most funds and ETFs have. We see 0.05% on 5 years on a year basis on an annualized return. We see that on the corporate side, and we see minus 0.78% on the government side. Also, that's because of the dollar. Government is the world government, and the dollar is a bit more difficult of late. If you take that together, you get minus 0.36% on the bond funds in the last 5 years. And if you're looking on YouTube, you see that the most banks and private banks are also in negative, or all of them are in negative territory on 5 years. So the minus 0.36% is actually not that bad, even in an active management style where you could go cash, where you could stay in cash. They didn't grab that opportunity, and still they're also, all of them are in negative territory. The second building block of portfolios.
So Tim, maybe before we go there, I see on your table you have one line with the Vanguard corporate bond ETF.
Yep.
And that one has a positive return over 5 years. Obviously, this is an index fund.
Yes.
And that's the ETF, right? The rest are all. Are the other ones actively
There's
managed
one,
funds?
the iShares Global. The iShares Global is also an ETF, also a passive fund.
Okay, so which ones are active here?
All the rest. So those two are passive, and the rest is active in name.
Yeah. Yeah, of course. Then what they do inside, maybe they don't do much, right? But so then, basically, I'd like to wrap up here, come to some kind of conclusion. What I see is when we take two ETFs, basically a balanced portfolio of 50% 5-year corporate bonds. No, not just corporate bonds and government bonds in ETFs. So two ETFs, average returns over 5 years is minus 0.36%, right? That's the last 5 years. And this is very similar to most actively managed funds that have similar bonds inside.
Yeah. That's true.
So the conclusion here is like actively managed funds with bonds seem to have done something like they have similar performance to the bond ETFs in this case, right?
Yeah, that's true.
Well, now there's a couple of them that have like very bad performance compared to the bond ETFs, but there's some of them are like in the same range. So okay.
Yeah. So it's not that bad in the bond sphere for the active funds if you look at the 5-year period. In the 5 years.
Yeah. And is it so? My understanding is that bond actively managed funds have a lower management fee than equity managed funds, equity actively managed funds. Yeah. Okay. So that's correct. Yeah. All right. Let's carry on. Let's do the same then with stocks this time.
Yeah. So the stocks, the second building block of most portfolios and most of interest usually to investors is the stocks or equity, like they're called as a group. Let's see here at all the equity funds, active funds, and there are also some ETFs here in the table.
In the list, yeah. I see them. Yeah.
We'll take for comparison maybe the combination of the two very known ETFs, the iShares, the IWDA, the iShares Core MSCI World, and the SPDR MSCI All Country World Index, the IMI. So those two are very known, and they're also the two that we suggest in our book, the Hangmatbelegger. So let's take those two as a comparison.
Yeah.
If you take those two returns on 5 year annually, they have actually averaged at 13.14%. So 13% they had as a yearly return on average the last 5 years.
Look, so this is every year on average over the past 5 years. They've done 13.14, so 13% every year on average over 5 years. Okay,
yeah.
That's pretty high, generally high for the stock market.
It's very high. It's not something you could expect for it could happen in the next 5 years, but it's not the average return for
we're above average. Yeah,
it's above average. Yes. So people beware, the stock market fluctuates. Like JP Morgan said, what will the stock market do? It will fluctuate. You see also here the active funds, and in opposition to the bond funds, we see not that great of a performance on the equity active side. There's only, I think, one private bank that comes even a little bit close at 12%, but the rest of them is a lot lower. Let's say 8 or 9% is about the average that the active funds are returning. So there's a 4% average gap between the passive side and the active side on the equity, on the stocks. So that's a big difference. It's a big difference.
4% annually.
Annually, yes, annually.
Right. So this is not only the costs, because cost would play a role here, but that would be 1 to 2%. So there might be something else at play here.
Yeah, there's a combination of the problems with decision making and allocation, of course, within the active funds is also of interest here. To be frank, in Belgium, the Belgium active management sphere has a little bit of a European home bias. So they usually like to invest more in Europe than in America or emerging markets. And we see here, for example, we have also a European ETF here, and you see, okay, that's not 13%, that's 10% average annually. So if you allocate more to Europe, you're at a disadvantage already. You're already at a disadvantage.
In the past 5 years, yes, of course.
In the past 5 years, yeah, in the past 5 years, yeah.
Okay, so that's quite important because then we are comparing funds that invest in slightly different markets.
Yeah, so that to be, I add that because it's common inside the industry. It's common knowledge that has happened. But even if you do correct for the European 10% plus a bit of America is still more than the 8 or 9% that we see on average here on the active.
Yeah, we would still maintain a 2-3% difference per year pretty easily.
Pretty easily, yeah. Very much so. So what I do with clients now, because we have the two building blocks of portfolio management, and what do most banks and advisors do? They mix them to defensive, neutral, and offensive portfolios, dynamic portfolios. And they add them together, bonds and equities. To make, normally there's a little less correlation. The last few years, there's been a lot of correlation between stocks and bonds. Usually there's less correlation, so there's a value in combining them to reducing the risk. But the last 2-3 years, it's not been the case. So if we go to the defensive side, I also have some defensive funds here that I brought with me on this slide. And what is defensive? It's about 30% on the equity or the stocks side and 70% on the bonds side. Now, if we take that division and we make it static, that's what we do for ETFs. Let's make it static, 30% in equity, 70% in bonds. The active side would have an advantage if they have great asset allocators. They could go more in equity, like say 40% in good times for equity, and for example, 20 in equity in bad situations. So here, the active side would have maybe an advantage to just combining two ETFs, a stock ETF and a bond ETF. But what do we see? If we combine the 13% and the minus 0.36% in the defensive ETF mix, we see 3.69% of yield on a 5-year basis. And if you see here the list of active managers, there's only one that's above 3%, and the rest is between 1 and 2%. So that's a lot of, again, it's about 2% difference between the active side and the passive side. And they have the added bonus, they could have changed the allocation if they wanted to. Okay.
And again, here we're talking about annual returns.
Yeah.
And so to summarize this slide for the other listeners, defensive for Tim here is 30% stocks, 70% bonds, not for Tim, for the industry. So that would be the defensive asset allocation. Mm-hmm. Using ETFs for the past 5 years, that asset allocation would have yielded 3.69% annually. So that's an average annual return, right? When we compare this to actively managed funds by Belgian institutions, over the past 5 years, not a single one comes even close. There's one that gets to 3%, but all the other ones are between 1 and 2, and one even below 1. So we have a difference of about 2% easily on average across all of this on annual returns. So over 5 years, that's easily 10% or more, right? Yeah. Despite, as you said, the advantage that they have that they can do some tactical asset allocation depending on their short-term expectations for either stocks or bonds, which they're supposed to be good at.
That's what you pay them for, and these are the typical clients, not also only defensive, and we'll see neutral and dynamic in a few moments. Those are the clients that I see, they have private banking portfolios that are defensive, neutral, or dynamic. And if you just compare them, and that's what I do then, I compare them to just a simple ETF portfolio. In most cases, it's crystal clear that they paid too much money and the returns were too low. And in most of the cases, not all, but most of the cases, that is true. That is true. So maybe we can look at the neutral portfolios and the balanced portfolios. Sometimes they're called around 50 equities and 50% bonds, 50-50. Also, again, here, the tactical allocation, indeed, from the financial industry gives them the opportunity, if they want to go, they're not going to 0%, but they can go to 40% in equity, or even 35%, or in good times, 60 or 65%. Usually they have those kind of margins inside their investment objectives. And here we see, if we make the calculations again on our bond ETF and our equity ETF, we come to an average of 6.39% annually on an ETF mix. So it gives an interesting return. But again, if we look at the active competition, we see even less results than in the defensive side. We see that the equity side apparently is the difficult one, but here we see, and as an average, I think that we see 3 or maybe 3.5%. So that's 3% difference on average between an active portfolio managed by professionals, by the best in the business, and they are the best in the business, but they're tied in different with regulations, with
constraints,
groupthink. They are. I've been in those committees. I've been with competitors. I've talked to competitors, to other banks. So not only the banks where I worked. They're smart people. They know what they're talking about. But if you're in a meeting, Sebastian, I don't know if you've been in a lot of meetings with like 6, 7, 8 people, and you have to decide stuff. It's not always rational arguments that win the case. Sometimes, and even in what you think is a cold, rational world, the investment world, even there, emotional things like ego, reputation, like career planning, comes into the things you say or do in these meetings. And that's an extra layer of problems active managers, in my perspective, have. And indeed, here we see the results. We see the results.
Mm-hmm. So here we see a difference of about 3% between a portfolio of index funds and a balanced portfolio neutral. So from private banks or banks. Okay.
The last slide I have here is the dynamic side, or offensive, sometimes what they call it. 70% in equity and 30% in bonds. Again, we take a static allocation and not something that can be changed, what the active managers can. And here we see a 9.08% 5-year annual return of the ETF mix. So that's the benchmark. For me, that's the benchmark. And we see that, it doesn't come close. It doesn't come close. We see even some with 6%. Some funds have a 6% annually underperformance against the ETF mix.
Yeah,
so
it's between 3 and 6%. So we're about 4.5%, we'd say. Interesting. So on average, we would say that if the portfolio is more aggressive or has more equity, the difference between index funds and the actively managed fund gets bigger by about 1% for each of those. So it's like 2, 3, and 4% more or less every time annual return on the performance, which obviously stacks up over 5 years. That's 20% easily, if not more, because obviously it compounds. Well, it works a bit differently when we see the sequence of returns, but it's a big difference. It's a big difference, and it gets worse for portfolios that are supposed to provide more returns.
Yeah. And I don't know if you've noticed, but in defensive, neutral, and the dynamic portfolios, it's each time a different private bank that has the highest return. So it's not like you can say, okay, let's go to the best private bank who has the least underperformance. It differs in every allocation. We see a different less underperformer than in each different. In defensive, we had one, in neutral we had one, and here in dynamic we have another one. So 3 times different banks. So it's not easy to pick them.
Yeah, plus it would be past returns, which cannot tell us anything about what they're going to do forward. This sort of comparison would be interesting if we take a 5-year period and then the next 5-year period and see if it's the same that outperform over the past, different periods. But we know from all the studies that we've read, you and me, that they certainly are not the same that outperform on a consistent basis. We don't know in advance which one's going to do better. And in any case, they all do worse than a simple portfolio of index funds.
Yeah.
Now, for the sake of being completely transparent here, we've talked about those portfolios solely the basis of their internal returns and their internal costs, not necessarily the transaction costs and other costs or taxes, right?
Yeah. This is all before taxes, indeed, and costs. Yeah.
So then I think for the audience, it's good that we could also speak about the differences here.
Yeah. So in what's usually the case, if you're a retail investor, you pay an entry fee, in a fund, usually between 1 that you pay for going in to be able to invest in one of those funds. If you go in ETFs, you have transaction fees and a TOB, a stock market tax, a transaction tax of usually 0.12%. So of course you have to deduct these of the returns, but if you go through an online broker and the 0.12%, let's say you pay 0.20% transaction cost and 0.12% transaction fee, with the numbers we set, that's not gonna flip the return side. And if you have to pay entry fees, some private banks waive the entry fees. But if you pay 1 or 2%, it's even worse. It's even worse than going through the ETFs.
And we have
because the
also,
management,
sorry, go ahead.
Because the management fee, to be clear, the management fees, the total expense ratios, those are in the funds and in the ETFs internalized, and they're deducted from the returns we talked about here. We're showing here on the screen. So the management fees are
Included.
already accounted for.
Yeah. And then we have fees at the end.
Yeah. So if you have an accumulating fund, you pay in Belgium a 1.32% tax. If there are bonds in your portfolio, so if you have a defensive, a neutral, or a dynamic fund, you also pay 30% on the plus value and the yield that internally has been created by the bonds. So there's the renders tax, like they call it. So you have to pay that also with you when you exit. In the ETFs, it's in the bond funds also. You pay the renders tax, but not so in the equity side. Because there are no bonds, you just pay the transaction fee, probably around 0.20%, and the exit tax of 0.12%. So that's for the moment, and I stress this is for the moment, the tax situation.
As in December 2023, at the time of recording, it could change because the government is speaking about potential changes, and when that happens, we'll come back here and we'll talk about it again. Tim, my understanding of the way the renders tax is calculated on mixed funds, I might be wrong here, is that they would say, okay, this mixed fund is 30% bonds. You've sold for, let's say, 1,000 euros of capital gains, right? So maybe you've sold for 10,000 and the purchase price was 9,000. So now you have 10,000. So 1,000 is capital gains. And because it's 30% bonds, then 30% of that 1,000 euros is going to be taxed because it's supposedly coming from bond returns, which is not the case. And so that would be 30% on those 300 euros, right? So it would come to something about 90 euros or something.
Yeah.
Is that way of thinking correct?
That way of thinking is correct if there is no Belgian, what they call Belgian TIS, Belgian taxable income per share. So that it's the way that it's taxed or seen if there's no internal Belgian total taxable income per share. We're going in the minutiae now, in the details, but it's important. It's important. If they keep track, that's a big if they keep track of every coupon, every plus value of a sale of bonds a fund has done, then, and if they communicate that to the bank that's selling the fund, they can calculate the 30% on the real plus value and interest rate. So that's a little bit of that's a difference, but sometimes it can be a big difference in the calculation.
I think it makes a very big difference, certainly, because most of the returns comes from the equity side of the portfolio, especially after a few years. So to me, those mixed funds have a higher tax burden when that is not calculated. So how do you call this number?
It's the taxable income per share. So they call it Belgian TIS in the financial industry. They call it Belgian TIS.
Yeah. So those, then when the Belgian TIS is calculated properly and communicated, and the tax is applied solely on the gains generated by the bond side of the portfolio for real, then I think I would say from a tax perspective, it's equivalent to a portfolio of ETFs if you were to sell both stocks and bonds at the same time in portfolio ETF, which is rarely the case.
Yeah.
But at least you pay your fair share. And if that's not calculated, which also is the case for most international funds, so when there is a fund that doesn't have this number, either Belgian or from outside, then we're also paying more taxes than we should on the bond capital gains, which is another point of something I wanted to highlight. Basically, another disadvantage of mixed funds. But if they have this Belgian TIS, then it's slightly better. I don't think it solves everything, because in many cases we don't have to sell bonds. but when they're mixed funds, then we do, because that's how it works when you sell those mixed funds. Do you have experience with people who are in the decumulation phase and withdrawing money from their portfolio?
Sometimes, yeah, and it's even if as an advisor, as a professional, you say when they start with these investments, beware, there is a tax at the end when you sell it. Let's be honest, most people have forgotten it after a few years. So when they sell their mixed fund, usually it's a very nasty surprise that they get, that there's still a big chunk of tax that has to be deducted. And some people say, oh, then we don't sell the fund, the active fund, for example. But of course, the tax doesn't go away if you don't sell it. It just keeps adding. In most cases, it just keeps adding and adding and adding. And I even had the very strange and I said that as a theoretical idea to my CEO when I still worked at a private bank and the random tax was new. I said to my CEO, I said, if people keep this mixed fund and they keep it for like 15 years and they're deceased and their heirs get the mixed fund, well, they have to pay inheritance tax on the sum, on the mixed fund, the total value with the random tax in it, but you can't see it if you're not selling it. So they pay inheritance tax on the big number. Then maybe they sell it to pay their inheritance tax, and there's a huge amount of random tax that goes off, that gets added from that gets cut from your investment. And you will be, okay, we've paid inheritance tax on tax. So we paid tax on tax. So if you have parents or let's say, or grandparents, and they have like those mixed funds and they have them 10, 15, 20 years, maybe give the hint to ask their advisor to look at the random tax, to make it. You can make a simulation. You can ask your banker to make a simulation of the random tax, and maybe change to a distribution fund. Okay, you have to pay the tax. That's painful. It's painful, but to pay inheritance tax on a tax is even more completely illogical, of course.
So does that, I mean, I feel like in the end we have to pay, we get kind of to a similar number towards the end, don't we? Like if we sell the funds before the inheritance tax is due, we pay the render's tax.
Yeah,
and then
so, for example, let's say
inheritance
you
tax
pay
on the rest.
You have like 100 in your investment, and let's say if you have it like 15 years, it could be that there is a tax of like 25%. So
if it's a bond fund,
it's a bond fund or a mixed fund, quickly to let's say 30% even,
because it's 30% of the capital gains
of the capital of the complete capital of the fund.
Of capital isn't 30% on capital gains.
Well, it's also on the coupons, on the interest rates that have been accumulated.
Yeah, so any gain basically, right? This tax at 30%.
If you like, if you have interest rates of 2-3% for 20 years in a row, then you have like maybe 60% plus value, and you pay 30% on the 60%. So that's a huge number. Yeah. If you deduct it when you sell it before something happens, okay, you have to pay the tax, but your investment drops from 100 to maybe like 80, 70 or 80. In your inheritance, you're only taxed on 70 or 80 instead of on 100. And if you, for example, pay the 27%, you have 3, 9, and 27%.
Yeah, so it changes maybe the limit at which we get taxed depending on the total amount of inheritance.
So, okay, of course, this is again a little bit of a special case, but it's not. I've seen it already, so it's not every day that we see it. But the longer the random tax is the law, the bigger the taxes become. So if we talk about this in 10 years time and they have still the random tax, it becomes, and some people bought mixed funds when they're 40, it's like 40 years of taxes that have been added and added and added and added. So
but I feel like if that's investment you need to have, then you have to pay this tax anyway, because if you sell early, then you reinvest it, you start paying the tax again anyway. So you just, the way to look at it to me is to know that obviously not all the investors know that it's there. It's just that to inform that there's 30% tax on this. So it will be there no matter what you do. If you sell, you have to pay. If you don't, and you sell later, you have to pay. And if you sell and then you reinvest in another thing that's similar, then you have to pay this tax anyway. You can't avoid, you can't just not pay it.
Well, what I suggest to some people is if they change their accumulate version to a distribution version,
you still pay.
You pay it, but the people in the inheritance don't pay on the plus on the tax. That's the difference.
So I think it makes sense. There's a calculation and optimization to be done for the inheritance part of it.
Yeah.
But we can't really do anything about the actual.
No, the actual tax is not.
We'll have to pay it anyway. Yes.
One of the most asked questions I get is, "Oh, Tim, there's a interesting on the stock side, on the equity side. There's no 30% tax. Can we have that on the bond side?" On the bond side, I said, no, we don't have it on the bond side. Sorry.
Okay.
That's the one thing. The one thing in Belgium, we can complain a lot about our taxes, but the one thing we have in Belgium are no taxes for the moment, December 2023, on the plus value of investments. So that's the little bit of thing the only thing we have actually that's good in the investing taxation story.
Yeah, and so to come back to my question about people who are withdrawing.
Yeah.
So people who depend, maybe they have their pension, but they want to also take back some money out of the portfolio.
Yeah.
Is there a way of doing this that's like smart, efficient, like related to the asset allocation, or like how do you, like what are the questions to think about at that point?
Until the new suggestion of law from our Minister of Finance, I thought, okay, there are two ways of doing it, and okay, it depends just on your psychology. You can get the distribution version of ETFs or of stocks, and you get the dividends. You pay 30%, but you're sure you get it. You don't have to sell capital. You get the coupons, and it feels mentally, psychologically, it feels better not to having to sell your investments in a bad year, for example. But tax-wise, it was probably a better idea to buy accumulating ETFs and selling parts of your ETFs when you need income. Good times, bad times, just sell them if you need income. That was until I heard of the last 2 weeks ago, I think, we heard of the new proposition of the Minister of Finance. It's not going to in law because they don't have time enough. But it changed for me a little bit of the equation on this question. If the next government picks up this proposition, and there is a chance they do that, you have 1.5% exit tax for accumulating ETFs. Now it's 0.12%, then it will be 1.5%. That for me changes the equation a little bit. The scenario where if you really need income, the system where you sell parts if you have a short horizon. For example, if you're 65 and you're saying, okay, in 2 years' time, I want every year, I want this amount of money. The system has, for you, in my opinion, has changed a little bit. In the past, I would have said, whether you take the distribution version or the accumulation version, it's about the same. And I think psychologically, if you can handle it, the accumulation version is tax-wise, fiscally, even more interesting.
Because of the equity part.
Yeah, because of the equity part. But now that there's a plan to get it to 1.5%, that changes a little bit for me, because if you have like 1 or 2 years and then you have to pay 1.5% on your investments, you sell it after 1 or 2 years. That's not
just on the withdrawal, right?
Just on the withdrawal, yeah. Just on the withdrawal.
So
we should do.
It's like it's a transaction tax, right? Yeah. But so we have to pay it for dividends. So yeah, it tips the balance a little bit more in the other direction. Now there's still modeling to do, I would say, because it depends on the proportion.
We should do a model about it, Sebastian. We should make some Excel files on it.
Yes, let's do that. And because if it happens, then we want to be ready, no, and think about the implications. Certainly, it will influence how we pick our investments. I'm pretty sure, and the strategy as well. So it will tip the balance a little bit, but this strategy depends also on the mix of stocks and bonds.
Yeah.
right? And I was wondering in your, like, I'm talking about my own personal situation here, but I am in the withdrawal phase, right? I withdraw from my portfolio every 6 months. We log in, we see how much we need to pay for the next 6 months, and we simply sell, right? And in my experience and my expectation is that I will mostly be selling stocks because stocks rise faster than bonds, and I want to maintain my asset allocation, right? My asset allocation is a specific percentage of stocks and bonds, and after a few years, it changes because it fluctuates, like JP Morgan said. And often stocks rise faster than bonds, so I end up selling stocks, which means I'm not paying tax on the capital gain, and my bonds are mostly untouched. Is that something you see as well? Because obviously my situation is quite unique. I don't have any other source of income, not even from my own personal business. It's just the portfolio. Is that something you see with your clients? Do they have to choose, okay, I will sell stocks or bonds, or is there like a predetermined way of which one you sell, or are you selling both every time? Like what's the
There's not one strategy, of course,
No.
Sebastian, you know that, but I do notice that the psychological aspect of it is very important.
Yeah.
I had a doctor specialist and who started at the worst possible time in the last few years, January 2022.
Yeah. Perfect.
And he wanted to retire in 2023, this year. He wanted to retire. And he just one more year, he started with a lot of equities, a lot of equity in the portfolio. And in 2023, I talked to him and I said, okay, are we ready to sell part of our equity? And he said, no, I can't do that. They're in the red, they're at a loss. He couldn't get himself to mentally jump across to say, okay, let's just look at it as income. He saw the red numbers next to the positions, and he couldn't sell it. So he worked in a year longer. I tried to convince him. I say, okay, but that's short term. Long term, it doesn't make a lot of difference. And you have to be able to sell with a loss in the investment sphere. But you see the psychological aspect. So what helps a little bit is distribution versions or stocks that give boring stocks that give a very high dividend, or bonds. For the moment, bonds with an interest rate, or also some income you can depend on. And you don't have to sell the principal. You don't have to sell the principal. And psychologically, it helps my clients to change from usually in the build-up phase, they use accumulating, but in the distribution phase, they start to switch it for emotional, psychological reasons.
Yeah, it makes sense. And it's like it's finding the balance between the education part that you can provide in like saying, well, look, it doesn't matter. Returns are returns, distribution on distribution. And then also adapting to the human psychology, which is, well, it's in the red, selling is bad, but it's also bad to take distributions at that point. And distributions go
Very
down.
true.
So you
Very
should
true.
sell to compensate. But. So that's quite interesting. Yeah, that's quite interesting. I guess it depends on the level of awareness and their dedication to understanding how to optimize for it. And it's not always a financial optimization. There's also okay, I understand it's not optimal financially, but still, despite knowing that this will not be optimal performance-wise, I still don't want to sell when it's red. It's like it's ingrained in us. It's very hard, I think. And somehow I think I've been in this world for so long that I don't even look at the number, whether it's red or green. I don't care.
Yeah. We're the exceptions, Sebastian. We're the exceptions.
Like, I don't care, man. This money is gonna be there for 40 years. So what it's now, it means nothing to me. I just need a little bit, so I'll just sell a little bit. But yeah, so that makes complete sense. And this strategy of switching to distributing then helps for those first few years where it could have gone down into the red. Now, if it was green, then it would have been it wouldn't help necessarily emotionally, but it would have been prepared for the case where it does go in the red.
What usually happens, Sebastian, is that people are in Belgium pretty conservative about their finances. And what I see is the equity side, which I usually recommend accumulating version. They don't have to touch it, because even I recommend to do a lot of equity because of the long-term possible plus values you get on the equity side. You see, they still have savings accounts, bonds, pension things that are fixed rates, and they just take it out of that side of their portfolio if they need money, and they leave the equity side in the fiscally interesting accumulating ETFs. That's what usually happens.
Yes, makes more sense. Yes. Yes. So
They say
there's
in the beginning, they say we have to think about the withdrawals. And when it happens, they usually find somewhere the money.
oh, we have savings there. And
We have savings there, we have savings there. And in a bad year, they're not touching the equity side.
all right. So having cash buffer is part of the whole strategy. So it makes complete sense. I guess my personal investment strategy is so optimized that minimizing cash is part of the optimization because I'm like almost vaccinated against the ups and downs of the stock market. I'm basically almost a pure index investor, Bogart style, not even looking at it. I have no idea what my portfolio is like. And I haven't looked at it in 6 months, by the way. This month we're supposed to withdraw. So I don't even know what the stock market is doing because that's how strongly I am committed to not caring about short term. I have
That's
no
great. That's
clue.
great.
I don't know. Like only when people say
it's my it's one of my advice to people. If you delete your app, I say
of course, no
that's a great
mobile
thing.
app. Yeah.
Delete
No
your app.
need. No, never look at it. Yeah, absolutely. Look, yeah. So I guess, but I'm quite unique in that sense. And I understand a lot of my teaching is helping people building that mindset of this is for the long term. None of this short term stuff matters. You actually want the stock market to go down now as you're putting money in, which is very hard emotionally when it actually happens if you put some. But 2022 was the perfect time to get started as long as you keep working for a few years. Right? Not if you retire or are retired like me, basically. But anyway, we've spoken about so many things, Tim. This is a fascinating conversation. We will bring you back on the podcast. I don't even want to ask you. I'll just make it happen. We'll
make it happen. We'll make it happen.
Record you again because this is fascinating. There's so much we can talk about. And so certainly that's an invitation, really, but I hope you will say yes. Where can people find you and what's the way to go and work with you?
Yeah, so they can find me through the Vermogensgids. I'll share here some on the screen the website and the mail address.
I will put them in the show notes for those who are in the audio as well. No problem.
Okay. And I'm pretty active on social media. So if you follow me on LinkedIn or X or Twitter, Twitter is X, Facebook even. There's a Facebook group Beleggen. If you're Dutch speaking, Facebook group Beleggen is also, it's something I try to moderate, but it's the wild west, of course. But I try to moderate it. And I've seen the shift, Sebastien, from individual stocks in 2008 or 9 when I started it. I've seen the shift, and the last few years, the group has turned to ETFs. Of course, I had a little bit probably a hand in it.
Yeah,
but,
awesome.
But you see the shift towards passive also in the social media sphere. So
that's amazing. That's really great. And look, I hope they'll benefit from this interview as well. And it helps them make even more the move in that direction. And then for those who want to talk to you directly, we actually have a partnership with Fire Belgium. You've joined us as one of the consultants. Mm-hmm. So if people go to firebelgium.com/one-on-one, you've been in here actually for a while, but it's a reminder to people that they can speak to you about index investing, personal finance, and specifically for people who are close to retirement or coming from the private banking sector, or would just like your way of thinking in this interview and want to have your point of view or your advice on anything related to investing. You can basically book a consultation here with Tim. There's also consultations with Ton and myself for those who want. But basically, these are the 3 consultants that we currently have as part of Fire Belgium consulting team, and we'll have more in the future. But Tim was my number 1 pick, obviously, for many reasons. And so I highly recommend anyone who wants to get one-on-one support, then please, be in touch with Tim. You can book consultation here, access to his calendar, payment, description, it's all there. And then you can speak to him, as soon as next week already, because it seems you have usually availabilities like within a week or so. And that's great. And thanks for making yourself available. It's, highly valuable for the entire community. Thanks for your time here. Any parting words, any final thoughts?
Let's say what I write in every book of the hangmatbelegger they ask me to sign is people just stay in your hammock, stay in the hangmat. It's the most important part of the philosophy. And in good times, it's easier. But I want to stress there will be moments, there will be years that this will go down, that the market will go down. And I hope you remember this advice then: just stay in your hammock, stay in your portfolio, stay in your ETFs.
Perfect. That's what I do. So much so that I have no idea what happening to the stock market, but I'm following your advice 100%. Tim, thanks again for being here, and until next time, everyone in the community, take care and speak soon. Cheers.
See you soon. Bye.